Imagine you're at a family barbecue. The sun is setting, and your Uncle Joe, who's had a bit too much to drink, starts one of his famous rants about the economy. Only this time, instead of turning him out, you find yourself nodding along. Why? Because you've noticed the changes too. Your savings account is suddenly earning interest worth talking about. Your cousin's tech startup is struggling to find easy funding, and the news is filled with stories of corporate defaults. It feels like the financial world has turned on its head. Welcome to Sophisticated Saving. In today's deep dive, we're exploring the seismic shifts caused by the Federal Reserve's recent actions, marking the end of an era of cheap money and the start of something new. So, let's unpack how these changes are reshaping the landscape of personal finance, Wall Street, and the broader US economy. Hey everyone! Glad you're here with us as we navigate through these interesting economic times. The Federal Reserve has been busy, and their actions are rippling through every aspect of our financial lives. From your savings to the biggest names on Wall Street, no stone is left unturned. Let's break it down, shall we? The Fed has raised the federal funds rate significantly quickly, a move not seen in over a decade. This decision, driven by the need to catch up and control inflation, has sent shockwaves through the economy. But why such a rapid increase? Simply put, the Fed was playing catch-up to curb inflation and normalize economic conditions after years of historically low rates. This monetary tightening has had a profound impact on Wall Street, reshuffling the investment deck and changing the game for personal finance. Borrowing costs have soared, affecting everything from mortgage rates to business loans. This shift has caused a reevaluation of risk and a more cautious approach to investment and spending. With higher interest rates, we're seeing a wave of corporate bankruptcies and a reevaluation of what it means to be financially viable in this new era. Startups and businesses that thrived on cheap debt are now facing a harsh reality check, leading to a more discerning investment climate. On a positive note, the economic landscape is changing in favor of savers, offering meaningful returns on savings accounts for the first time in what feels like an eternity. This shift represents a significant departure from the near-zero interest rates that have characterized the financial environment for over a decade, essentially penalizing savers and incentivizing borrowers. Now, with the Federal Reserve's decision to increase interest rates, those who have diligently stashed away their earnings in savings accounts are finally seeing the fruits of their patience. High-yield savings accounts, certificates of deposit, and money market accounts are witnessing a resurgence, offering annual percentage yields that were unthinkable just a few years ago. In this new era, savers are positioned to reclaim a more significant role in their financial management, supported by a banking environment that recognizes and rewards their commitment to fiscal responsibility. However, this new economic era also poses nuanced challenges, particularly in the complex realm of wealth and income inequality. Historically, periods of low interest rates have served to widen the wealth gap, as those with assets to invest have seen their value soar, while others, reliant on wages and savings, have not experienced equivalent financial growth. Now, as interest rates rise to temper inflation and stabilize the economy, there is a critical need for adjustment strategies that ensure growth does not disproportionately favor the wealthy, further deepening societal divides. This adjustment requires a delicate balance, fostering an environment where economic opportunities are more evenly distributed across all societal strata. This endeavor may involve innovative fiscal policies, targeted financial education, and community investment programs aimed to elevating the financial security of lower-income families. thereby narrowing the gap that has long characterized economic landscapes, not just in the US, but globally. The housing market is currently under considerable pressure as mortgage rates continue to climb, significantly impacting the affordability of home ownership and the viability of real estate investments. This uptick in borrowing costs means potential home buyers are facing higher monthly payments, effectively narrowing the pool of individuals who can afford to enter the market. For investors, the increased cost of capital diminishes the attractiveness of real estate ventures, as higher mortgage rates can erode potential returns, leading to a cautious reevaluation of investment strategies. Simultaneously, the job market stands at a pivotal juncture, presenting a dichotomy of potential outcomes. The delicate balance between stimulating job growth while managing inflation and interest rates is critical to ensuring a stable economic future, making the current era one of cautious optimism mixed with a keen awareness of the potential hurdles ahead. For the average person, the current economic climate presents a dual-edged sword of opportunity and caution. On one hand, savers are finding themselves in a more favorable position than they have been in years, with interest rates on savings accounts and CDs climbing to levels that finally offer meaningful returns on their deposits. This shift represents a significant change from the near-zero interest environment of the past decade, allowing individuals who prioritize saving to see their patience rewarded as their financial reserves grow at a more palpable rate. On the other hand, borrowers and investors are facing a markedly different reality. The era of cheap money is waning, and with it, the cost of borrowing homes, cars, and education is rising. This means higher monthly payments and more interest paid over the life of loans, pressing borrowers to reassess their debt management strategies and possibly delay or scale down major purchases. This period of transition underscores the importance of financial literacy and proactive planning, as individuals work to balance the pursuit of growth opportunities against the need for caution in a changing economic landscape. The Federal Reserve's shift towards monetary restraint marks a new chapter in the U.S. economy. This era of higher interest rates and tighter financial conditions will test businesses, influence personal finance strategies, and potentially reshape the economic landscape for years to come. If today's discussion has sparked your interest, or if you have insights on how the Fed's policies are impacting your financial decisions, let's keep the conversation going. Hit that like button, subscribe for more nuanced takes on the economy, and share your thoughts and experiences in the comments below. Until next time, keep saving smartly and investing wisely. See you in the next video, sophisticated savers.